Thank you all for being here today. As I said, I'm in Park City. Ray, where are you?
Arthur, I'm in New York.
New York City. Ed?
I am in Westport, Connecticut.
Westport, Connecticut. So thank you all for joining us today. This is a second version of learning what Gilded is all about. And just for the record, we're recording this. And so if you want to visit it later, we're going to be posting it to the Family Office Insights YouTube channel. And that also will be putting everybody in direct contact with the folks at Gilded. This presentation today is around the benefits of investing in what Gilded has done rather than investing in the company. And so I just want to be clear about that. So if there are others that you, after listening today, that you think would benefit from learning what you learned today, please feel free to connect them directly with the company. And as you know, we stay out of the middle here, so you don't have to connect with us, and you're totally at liberty to connect with the company. So we're glad to have you guys again today. So also feel free to ask questions as they come to mind. Please do so as they come to mind, simply because we have a lot of people coming on and would like to get to as many of your questions as possible. So with that, Ed, am I handing it to you?
Yeah. So why don't we do this? I'll introduce myself. Ray will introduce himself. We'll talk a little bit about what Gilded is, but then we want to dive right into the problem that we're trying to solve and how we're going about doing that. So to start out, my name is Ed Helena. I've been in the financial markets for over 30 years. Started my career at UBS. I was there for 20 years. Did a variety of roles, including foreign exchange and precious metals was included in that. And like you guys, I was an investor the last 5 or 10 years. I focused almost all my time on private equity investments, real estate investments, but I got drawn back into this based on my relationships with some former UBS colleagues who are on the management team here at Gilded, as well as the product itself, which I think you'll find is quite interesting and quite innovative. So that is my background.
Just want to say thanks to Family Office Insights and to Arthur for having us here today. We're really excited to tell you about what Gilded is offering. I come to Gilded from a winding path. I started out in the financial markets as a derivatives market maker in foreign exchange, and then a fixed income proprietary trader, and then finally managed an emerging markets business out of Europe for UBS and all the incarnations of UBS. I left the markets for a bit and then realized that I wanted to come back to Wall Street. So I did so as an investor. I went to Blackstone, where I was part of the Blackstone Alternative Asset Management Group, looking after a $35 billion portfolio invested mostly in hedge funds. When Blackstone went public, I was on the executive committee there with Steve Schwartzman and Pete Peterson at the time, Tony James. And after the IPO cleared, I decided I would take a little bit of a sabbatical. And before I knew it, I became a tenure track professor and then a business school dean. And I came out of my permanent appointment as a dean to join Gilded, as Ed Helena mentioned, partly because of the quality of the team, but also because of the timeliness of what Gilded was offering. As you'll see, the solution that Gilded offers is a way for us to make it easy to access physical gold, to offer a solution to the problems of fiat currency, because we can use technology to make that gold useful in ways that it hasn't been useful for centuries. So with that, I'll pass it back to Ed to get us started.
So, Gilded was founded by our CEO, Ashraf Rizvi, we call him Riz, because he really felt that we have an issue in the world with fiat money. And, a lot of people think this. We've got, inflation, we have money printing, we've got credit exposure in a way, and geopolitical risks now. And so there are lots of reasons people are looking for alternatives to fiat. I mean, crypto is just one. You see people putting money in various places right now. But gold is really a traditional store of value, and it always has been. And so, what Gilded is doing is trying to improve on fiat money by using a historical store of value, which is physical gold, but improving on it by making it digital. And what that means is we're making it a lot easier to purchase and store and sell your gold eventually. than traditional physical methods. You still have the direct ownership of the gold bar. It is your property. It is sitting in a vault that you own. It is your title. It is your property. That is different from a lot of other types of stable coins or other kind of crypto style investments. So you do have ownership and immutable property rights. But because we're digitizing it, and we'll explain what that means in a minute, your gold is mobile. It's usable. You can access it 24/7, and you can use it to pledge it to basically monetize it. And that makes a physical gold bar sitting in a vault something that's a lot more useful than a traditional physical gold investment. So that's what we're going to talk to you about today.
So as Ed mentioned, Gilded was founded by Ashraf Rizvi, who ran the commodities and precious metals businesses at UBS for a long period of time before he launched his own commodity fund, which ultimately ran up to about $5 billion in assets. Unlike a lot of other fintechs, this group at Gilded really has deep financial market experience. Now, it doesn't mean we haven't hired folks from places like Google and Facebook, IBM, even Bell Labs that can help us on the innovation side. We also partner with best-in-class service providers to put our technology solution together. But this isn't just five young guys in a garage that are great at coding. This is a lot of experience being brought to bear on this financial solution. So when we started the business, we're following a lean startup method. We launched a retail application that was accessible by mobile phone. We were available in 14 different countries. We had thousands of transactions of small amounts of gold on a daily basis. We had hundreds of thousands of followers on Facebook. And what we learned from that experience, we got a tremendous amount of data. And we realized that the solution that we were offering and that the value proposition of the use function for gold, in particular, being able to pledge gold for portfolio purposes and for margin and so forth, which we'll get into in a little bit, that really applies to institutional investors. And so we've made a pivot to focus on the types of high net worth clients, financial institutions, corporates, and even sovereigns to be able to use this solution. And so with that, Gilded now has this vision of freedom from fiat and a mission to make gold digital, mobile, and usable. And what does that mean? By providing an easy way to access physical gold ownership, we are offering an alternative to fiat. Now, there are other ways to get gold ownership, ETFs, not physical gold ownership, and then the traditional ways of physical gold ownership, which has challenges. Is it really gold? What's the quality? How do I transport it? How do I insure it? Where do I store it? Gilded is solving all of those problems. And we're using blockchain technology to make the record of ownership transferable instantaneously. And with that, we can make it useful. Now, it's important to say, again, we're not a stable coin, even though we use blockchain, but we're using it to make sure that we can transfer value. You know, speaking to a group of family office investment professionals, I have to say, I do not envy you today. You have a host of problems. And of course, the other side of that coin is your clients need you more than ever. So it's a really nice balance, but it doesn't change the fact that today's markets are really challenging. We don't need to talk about global geopolitical risk. You know, what's going on in the Ukraine and Russia is one thing, but it spills on to energy usage in Europe and the economies, the big economies of Germany and Western Europe. It spills on to Iran, what's going on with North Korea. It extends, its tentacles extends far and wide, and the implications are really unknowables. The other thing that's going on in the world right now is governments are just printing money at an unprecedented rate. And if we go back and just look at the United States, and this is true for all of the developed world as well, but the United States in 2006 had a debt to GDP ratio of about 60%. 15 years later, it's 130%. Tremendous increase over a number of years. A similar pattern with the Federal Reserve balance sheet. Before the financial crisis in 2006, the Federal Reserve's balance sheet was less than $1 trillion. And right now it's sitting at about $8 trillion. What a tremendous multiple of increase in money that's out in the system. So there's a response for this. And so it shouldn't be surprising that inflation levels are higher than they've been for 40, 50 years. So that's in front of mind right now for most of our investors, our clients. They're thinking about inflation, but inflation is always a problem, and it's a structural thing. Right now, the alternatives to inflation are the thing that become a challenge. So if we think about what we can do as advisors, well, we can point our clients to real property, art, wine, collectibles, real estate, physical gold. The problems with real estate, art, and wine, Picasso, it's challenging to generate liquidity. Once you're involved in a property, real estate, it's not so easy to generate liquidity on a short-term basis. And what Gilded is doing is allowing for liquidity to be generated with physical gold without having to have a tax event to sell the gold. What about equities? Well, when you have geopolitical risk, when you have valuations for equities that actually are at very high historical levels. So if we look at Robert Schiller from Yale, he has the CASE index, the cyclically adjusted PE ratio, where you take a 10-year PE ratio, moving average, and you look at the valuation of the equity market on that basis. He's tracked it since 1871, and it's only been higher one time in that history, the internet bubble. So today is the second highest. So even with the correction that we faced, equities are still very fully valued. So it's tough to be advising your clients to weight their portfolio even more towards equities in this environment. And then tips, bonds in particular, real yields negative today. The 10-year real yield just tweaked over to the positive side, but they've been hovering around negative rates, and tips are not that much better. And it's not clear that a 3% inflation break even makes sense right now. So asset markets are rich. There are few alternatives, whether they're bonds or equities or property, that offer the kind of thing that will get investors the safety from inflation that they're looking for. So Arthur and Ed and I were talking at the beginning of this. Arthur has Ray Dalio's book, The New World Order, on his desk there. And Ray Dalio is famous for having said cash is trash. He said so recently. And this is a problem. There it is.
Look, I can do props, right?
So Arthur, you didn't know this was coming, but this is a real problem for investors. And most of us realize our investors have too much cash. So when Ed, Helene, and I talk to private banking folks at places like Goldman Sachs and JP Morgan, Credit Suisse, and UBS, we know that investors, even sophisticated investors, are holding as much as a quarter, sometimes 30 or more % of their portfolio in cash, even in this environment. So the markets have been flooded with cash. We've had the stimulus from the COVID pandemic. We've got companies holding billions of dollars in their treasury. We've got central banks holding an extraordinary amount of reserves. And in the meantime, we've got inflation running. Last month's print was 8.5%. The PCE deflator that we just saw, the headline number was over 6.6. And if you take out the stuff that people eat and how they afford to live in a home, then it's only 5.2%. But it's hard to figure out how you take out the food and energy and really look at the situation. And so what that amounts to is a steady decline in purchasing power for that significant portion of the portfolio that's in cash. What we're trying to do at Gilded is offer an alternative to that. And we think that gold has served that alternative in a number of ways. And let me just list them for you. First of all, gold has compelling returns historically. So if we go back from 1971, the year that Richard Nixon decoupled the US dollar from gold, and we look at returns since then, gold's returned about 8% since 1971, when it came off the gold standard. Now, equities over that time has returned about 11%. So gold has really held its own in that period. But if you look at the period from 2000, the introduction of the euro, to today, gold's returned 8.6% and equities have only returned 7.5%. Let me repeat that. Gold has outperformed equities since the dawn of the millennium. Professional investors look at me and tell me I'm wrong all the time, but I promise you, go to Bloomberg, take a look at the data, and you will see that gold has actually outperformed equities. Now, I want to emphasize, Gilded is not here to tell you to reallocate from an equity portfolio or an alternatives portfolio into gold. What we are suggesting is that for your clients that are holding too much cash, this is the right alternative. That being said, the returns have been particularly attractive. And in an inflation environment, even more so. During periods from 1971 to 2021, when inflation is over 2%, gold has returned over 13%. And equities have caught up pretty nicely, about 12.9%. But at those periods of inflation where it's unexpected, now we expect a certain amount of inflation because central banks have something called an inflation target. They are structurally driving economies towards inflation. So we expect a certain amount of inflation all the time, but when it's higher than what we expect, gold performs particularly well. It's also a diversifying asset in a portfolio. It's uncorrelated to equities, and it's only about 0.4 correlation to bonds. So if we can get an uncorrelated asset with positive returns added to our portfolio, that's always an attractive proposition. The other thing about gold is it tends to perform well when the world is not performing very well in very significant stress scenarios. So if we think back to the stagflation of the 70s and the oil crisis of the 70s and 80s, if we think back to the 87 crash, the internet bubble of 2000, the great financial crisis, 2007 to 2009, the start of COVID. During all of those periods, gold has offered positive returns while the equity markets have been down. And as a financial advisor, when those situations are happening and your clients are starting to scream, you can look like a hero if you've made a recommendation for something that can hold value in a scenario like that. And then there's this one concept that's really important, and it applies to physical gold as opposed to paper gold. So physical gold is actual property. It's your title, it's your client's title, it's their ownership. It's not a financial asset that has to be managed. For example, a gold company, gold mining company. There's a manager, CEO is deciding where to drill the holes. Will they pan out? Will there be as much gold there as they hoped? Will they pay their employees too much? Will they take on too much debt? Will they manage their company properly? Similarly, ETFs, they're managed instruments. They're financial pools of assets with managers. They are not physical property. So physical property has the benefit of being bankruptcy remote, and you can store it outside the banking system. So even with shares of stock, you've got to store those with a brokerage firm, and sometimes brokerage firms have problems. So I remember looking up SIPC insurance during the great financial crisis and thinking, my gosh, what's going to happen next? So having a portion of your portfolio outside of the risk of those systems is pretty attractive. And last but not least, it's not a cryptocurrency what we're talking about. It's not Bitcoin. So for your investors that are sensitive to the environmental costs of operating a Bitcoin network, or had listened to Warren Buffett at the last meeting where he said he wouldn't buy all the Bitcoin out there for $25. Now, I don't know if I agree with that statement, but there are a lot of investors out there that are listening to Warren Buffett. And so what you see here on the left is a picture that describes the eroding purchasing power of the dollar since 1970. So from the time that Nixon decoupled the dollar from gold, your $1 back in 1970 can only buy about 10 cents worth of stuff today. What a tremendous erosion of purchasing power. And you can see on the right that if you put your money in at that time from the same period, either in gold, or you compare that to CPI, or you put it in T-bills, you can see what a store of value gold has offered over a 50-year period. And even over a 20-year period where bonds didn't keep up, cash didn't keep up with inflation, gold has kept up quite nicely as a store of value. Just a couple more pieces to illustrate. In terms of portfolio diversification, The darker gold line you can see is the correlation between gold and stocks. It's hovering around 0. So historically been uncorrelated, which is a beneficial asset in most equity-based portfolios. And with respect to bonds, again, hovering around 40–50% correlation. So a diversifying asset, which is always handy to have. I mentioned before the stress scenarios, and this is where you can see it. So the gold lines are these returns on gold. The blue are the returns on stocks during those stress environments that I mentioned before, the 1970s, the 87 crash, the 2000 internet bubble, the great financial crisis, and the onset of COVID. In each of these cases, gold has significantly outperformed equities. So take a look at this analysis that we put together. We used UBS, in this case, their family office report has a typical portfolio allocation for high net worth investors. You can see it's got about 1/3 in equities. It's got alternatives like private equity. It's got real estate, some hedge funds, fixed income, cash. What we did was we reduced the allocation to cash from 13% to 8% and reallocated that to gold. And what we found was from the period of 1970 to the December 2021, just the end of last year, a reduction in the overall maximum drawdown in the portfolio, and higher Sharpe ratio and higher returns. So in the asset management world, we call this a free lunch. If you can actually reduce the risk on your portfolio, increase the expected returns, and lower your drawdowns, it's something that you really want to look at very closely.
So the argument against slicing off some of your cash and putting it into gold in this case would be, well, what would be the liquidity issues, right? So I'm setting you up to answer a question that you guys have solved. But the thing that struck me when I first had a conversation with Paul and your colleagues was that one would argue that an asset as stable as gold could be easily hypothecated or used to loan against. And it really isn't that easy, right? And so I think one of the things that you guys have done, aside from, to use a tech term, created a good user interface to buy gold, is also created the functionality that you could hypothecate it in the event that you needed cash and have that as a turnkey solution within the offering.
That is an excellent segue. So what Ray has talked about so far is the problem of cash inflation and the eroding returns of being over diversified into cash. We've talked about gold. We've talked about gold's historical characteristics, return characteristics, which, to be honest, most of us probably already knew, and it was a good reminder to hear about it. The problem with physical gold historically has been it's a rock in a box. It's a paperweight. It's a big brick that needs to be stored either in a safety deposit box or a vault somewhere. Some people keep them in their bedrooms in a safe or whatnot, but either way, it doesn't do anything for you. It is merely a store of value. And yes, you can get liquidity by selling that store of value or trading it. Some people invest in jewelry. Jewelry is very idiosyncratic, though. Its worth, its worth could be very different than the physical properties within the jewelry. So when you want to invest in physical gold, your options are pretty limited, and they're also very cumbersome. So what we're doing, which is different, is we're adding a layer of technology to the process, which really transforms physical gold into almost a digital product, not crypto, not an NFT, but similar in that it's the ownership record is now digitized. So if you need to use the ownership record, it's much easier because it's on a blockchain and it's digital. So let me walk through what that means. So when you purchase gold from Gilded, we purchase gold directly from one of the 4 big Swiss refiners. And we have that gold shipped to Brinks vault. And we have a network of Brinks vaults around the world, but for the sake of argument here, we'll say it's in Zurich. So you would purchase gold. We do that. The pricing is at the fixing price, the LBMA fixing price, which happens twice a day. So it's a very transparent mid-market price. We do add a margin to that for our efforts, but you own the gold, you buy it from the Swiss refiner. It is stored on your behalf in a Brinks vault. It's not our gold, it's your gold, it's your title, it's your property, but it's much easier to purchase it that way than historical ways. We keep a blockchain record, which is an immutable record. It is a ledger that records the ownership of that gold bar. And furthermore, we will provide a picture of that gold bar to you. So on your phone, you will be able to see a picture of the gold bar that you just purchased. The gold bars come in increments of 100 grams. 100 grams is roughly about $7,000 worth of gold. That's one of the reasons Ray had discussed earlier how we've moved away from the retail and more in the institutional space. That's one reason, is the minimum size is a 100 gram bar. But we also sell kilogram bars or even 12.5 kilogram bar, which is worth $800,000 or something. So we are, enabling the purchase of physical gold. But more important than that, once that gold is held digitally, the gold can be used in a way that makes it much more usable than a gold bar, a brick in a box or a paperweight. It suddenly becomes not just a store of value, but a medium of exchange. That gold can be pledged. It can be used as collateral. It can be used to transform an asset that you own into liquidity. And you can do that without having to sell the gold bar. If you want to sell the gold bar, you can. The wash rule in the US says that you cannot simultaneously sell an asset and buy it back, or sell a security and buy it back to lock in a tax loss. You have to wait 30 days. Gold is actually it's a physical commodity. It's property. You can sell a gold bar and buy another gold bar. So if you wanted to sell your gold holding to lock in a tax loss, you could. But assuming that gold goes up over time, you may want to have liquidity from your gold, but you don't want to sell it and have a taxable event. So what you do instead is you would pledge it. You would pledge it as collateral. And there are institutions that love taking gold as collateral. It's one word for it is called right way risk. Try saying that 10 times. Right way risk. Right way risk means that when the world is going to hell, the asset you're holding, you also don't want going to hell as well. Gold tends to be negatively correlated in risk on events or down events. So it's right way risk. It's good collateral. And many institutions are willing to loan 80 or 90% against gold so that you're able to monetize it fairly easily. Now, a security, because of Reg T, the most you can borrow against a security is 50%. So, for the purposes of needing liquidity, traditionally gold is very hard to acquire and then to use as collateral. But when it's been digitized and you have a digital ownership record, and an institution will take that record and considers it as good as the gold bar itself, then you're able to monetize it. And that's what Gilded is doing in a nutshell. So when I say monetize, there's several different variations of that. So one, which I just described, is a secured loan. You pledge it as collateral in the same way that you would mortgage a house. You would pledge it as collateral and you would get cash in return. So that's a secured loan using gold as collateral. We are working with the exchanges right now for clients that have gold and want to pledge it to an exchange's initial margin, be able to trade futures and options on the exchanges using gold as initial margin, which is another way of monetizing it. In terms of returns, one of the drawbacks of physical gold is it is a asset that does not have a dividend. It does not have a stated yield. It does have a return over time. It has historically performed, I think, Ray, you said 8% a year, somewhere in that vicinity. So historically, it does have a return, but it doesn't have a dividend. However, when your gold has been digitized, there are ways that you can enhance your returns by pledging it, lending it, or purchasing a structured product using that. And as I mentioned earlier, because of the lack of a wash rule applied to a physical commodity, it could be more tax efficient to buy physical gold than it is to buy a security. We've also just started discussing with different banks repo financing, so pledging gold as in a repo transaction, and again using it as margin for different types of loans. So that's sort of like the high level of what you can do when your gold is now recorded on an immutable blockchain, and that digital ownership record is accepted by the institutions that we've partnered with in a way that you can't do with a traditional physical ownership. So here's an example of that. So, just a typical cash flow would be that an investor purchases gold. It's directly sourced from a refiner. By the way, the gold that we source from refiners is 99.99% pure. Not all gold is, but that is the purest gold that you can get. It's been ethically sourced. It corresponds to Wolfberg principles. So that gold is, as I mentioned, is delivered to a Brinks vault where it is your ownership. It is insured by Lloyd's of London. It is independently audited, and it is the physical property of you, but it sits in a Brinks vault. We create a digital record of that gold on our blockchain, and that blockchain as well is also audited and verified according to the ownership records at Brinks. So once we have that digital certificate, or once you have that digital certificate as the owner of the gold, we have made arrangements with different banks that they will take that ownership record and they'll offer a loan against it. So basically the workflow is you purchase the gold, it's in a vault, you get a digital certificate, you can pledge that digital certificate. We will work with the bank to encumber that gold, to set it aside until the loan is paid off. And when it is, the gold goes back to the owner. So, I mean, I'm stating the obvious here, but what would you do by pledging gold? Well, as Ray was saying earlier, if a family office or an investor wanted to keep, let's say, 20% of their holdings in gold and cash, there might be a number of reasons for that. And if you were to convert, say, half that cash to gold, you would basically be missing out on some dry powder. You would have less liquidity. But because you can borrow against the gold, you can do a lot of different things with those borrowings. You could, if you wanted to, you could purchase more gold. You could lever up your gold ownership. Sometimes if there's a real estate transaction that needs to be closed and you need liquidity for that, you can get a loan against your gold to do that. As we know, there are capital calls in the private equity world or the venture capital world, and sometimes you need cash immediately for that. Many of us use our cash allocation for working capital. These are businesses, and there's working capital needs throughout the investment life cycle, as well as buying stocks and bonds. So, pledging your gold and borrowing against it, using the immutable record of the blockchain that we've created and the database that we've created, and using that with our partners, really frees up the owner of that gold to do all of these things, which is what cash has traditionally been used for. So what we're really trying to emphasize here is not to think of gold as your grandfather's investment, or your grandmother's investment, of buying coins or buying bars or buying physical gold and sticking it in a vault, but thinking it rather as almost like crypto or some other type of investment where it's cash-like, but it's outside the financial system. It's outside the banking system. It's physical property. There's no credit exposure. You don't have to worry about FDIC insurance maximums. It is a product that can act and behave like gold, but it has the physical properties of ownership. And that's really what we're doing here. So I mentioned the blockchain. I won't get into that in a lot of detail. I mean, for those that are not that familiar, all a blockchain is it's a ledger. It is a ledger that imbues trust because the parties to that ledger view it as immutable. The seller and the buyer of a transaction that is recorded on a blockchain is accepted by all people on that blockchain as a done deal. So think of blockchain not as a cryptocurrency. That's like what Amazon is to the internet is what crypto is to a blockchain. Blockchain is a style of a ledger. It is a technology. It is It is a way of keeping records. Cryptocurrencies are built on top of that. We are not a cryptocurrency. We are using blockchain as a ledger to record ownership and to record properties of the physical gold bar that you would own. But the ownership of that gold bar is yours, and the value of that gold bar is completely tied to the value of gold, not to some token or coin or crypto that's on top of it. I'm going to pause there, actually, I think, before we start talking any further. I know that we've been inviting questions on the chat, and there are none there, but perhaps, Arthur, if there's some questions that come to your mind, we could jump to that.
I did see a question from Richard Ross. It's a good one. I think we can pause and address that now. So Richard's asking, what's a good allocation for gold plus Bitcoin? I think some clients will want crypto in some form in their portfolio because it is, it's out there. Some will want to stay away from it because of the environmental reasons. If you asked Warren Buffett that question, he'd say, well, zero Bitcoin. But hearing Ray Dalio talk about this, I thought was one of the best answers, actually. And his approach was, well, I don't really know Bitcoin or other alternatives to fiat, whether they're going to be, how they're going to work out. But if I look at the market cap of gold globally, it's about $12 trillion of gold. There's about 200,000 tons of gold out in the world. If I look at the market cap of gold, and I compare that to the market cap of Bitcoin right now on coinmarketcap.com, you can see that Bitcoin is about $350 billion market cap. And Ray suggested, well, why don't I just take a blind allocation, and I'll use the same fraction of market cap for my allocation in a portfolio if I wanted to mix Bitcoin and gold. So you'd have a sort of just roughly a 1 to 12 or 1 to 13 split of Bitcoin to gold. We've used an asset allocation model in that pie chart that we showed earlier, where we had 8% gold, but for some of your clients, it'll be less than that. For some of your clients, it might be a little bit more than that. So Richard, I hope that helps.
Yeah, just to add to that, I think the way I was at the SALT conference this fall in New York, and Ray asked the audience, raise your hand if you have any exposure, you own any cryptocurrencies, and most of the room raised their hand. And then he asked the same question about gold, and maybe a third to half the room raised their hand. And he said, I don't understand. If your belief is that fiat currency is devaluing, and he said, I share that belief, and you're using crypto as a way around that, why would you not be invested in gold? He said gold shares the exact same properties, but even more so, it's got more liquidity, it doesn't move around as much, and it's been a store of value and trusted as a store of value for far, far longer. I mean, it goes back 5,000 years versus a decade. So his view was you would allocate to both if you are going to allocate to one or the other, and that he thought it was wise to do so. And obviously, we share that view at Gilded. I don't know about the crypto, but we share the view about gold.
So, would you argue that one of the reasons, aside from increased utility, that you've put this on the blockchain, that it offers confidence in provenance, which is something that people struggle with, knowing that they bought some gold and it's sitting in a vault in Switzerland and they don't really understand how that provenance could be at risk by nefarious activity between the buying of the gold and then storing it? Like, I'm not saying that goes on, but would you argue that you've eliminated that provenance issue?
Well, I'd say that's a great question. I think it's an important one. If we look at nefarious activity around the world, we know that the United States $100 bill is the most laundered instrument on the planet. It's funding what's going on in Russia, Iran, North Korea, you name it, mafia type activities, black market activities all around the world. Gold happens to be the second most laundered instrument. And so Gilded is firmly committed to regulatory compliance in all the jurisdictions where we operate. We are fully committed to the Wolfsburg principles of know your customer, know your client, source of wealth, source of funds. So, you know, that to us is really important. And the way that we source our gold, we're using a handful of the best refiners in the world that make representations about the ethical sourcing of this gold. All the bars are LBMA compliant, as LBMA good bars, good delivery bars, but the refiners also make representations that the gold is sourced ethically. So that's a great question, and Gilded is firmly committed to doing that. And I think it's one of the principles that we have in terms of offering environmental, social, and governance benefits. The way that we operate as a firm, if we can have good governance and get more gold onto our network, you know, we're in a position where we can improve the world with having less nefarious activity happening with gold. We'll move to questions. I'll just go back to that ETF slide for a second. This is a thing that I think a lot of experienced investors are sometimes surprised by, which is some of the misperceptions around ETFs. Now, ETFs, I'm not here to say that they're not a fantastic product. They're incredibly profitable for BlackRock and State Street. They are really useful for short-term exposure to the price movements of gold. So if you have clients that want to have some short-term exposure, these instruments are fantastic. But there's some misperceptions. When you buy an ETF, you don't own gold. You don't own gold. You own shares in a fund, and the fund is managed by a trustee, and the trustee has a custodian, and the custodian has a sub-custodian. Delivery is not guaranteed. There are mechanisms provided for delivery to make it possible, but there's lots of wiggle room. The only way to find out these things is to really go through the prospectus. And unlike property, which doesn't require a prospectus, a fund does. Funds are not insured. You don't have control over taxes. And if you're going to hold it for the long term, the ETFs are really clear about this. Your holdings will be reduced over time to pay for the fees of the fund. So you won't be able to maintain long-term exposure unless you actively go out and buy more shares of the ETF, because your holdings will be reduced over time. So there's some real fine print that even sophisticated investors sometimes haven't had the chance to really delve into the details of the prospectus. But for intergenerational wealth, for people that are saving for a really long term, physical gold is superior, with the trade-offs that Arthur mentioned. It's hard to generate liquidity, and it's hard to make that argument that you can reduce cash, but Gilded's been working to solve that problem.
You know, one last thing I would add to the previous point about provenance is that, you know, when you buy gold and you need to move it, either because you're selling it to somebody else or you want to transport it somewhere, it's very expensive. You know, it is not easy to do so. And by keeping gold in a vault, and the gold stays there, but the ownership record is digital, and the ownership record, the digital ownership record, is what changes hands or is being used to pledge or encumber gold in a loan transaction. It makes it much more environmentally friendly. I mean, you're not actually having to require, you know, armored trucks to move around and security guards to go around, and you know, it's a much less environmental footprint that you're using to do so. So, you know, digitizing a physical product like gold really does, you know, improve things for the world a little bit too.
And there was a question in the chat about relating to someone has a client that already has gold, and can they use the Gilded network? And the answer is yes. So we can accept gold, that gold bars. We do have a process to bring them onto the Gilded network. In some cases, they may need to be re-refined, but there is a process, and we can take you through on a case-by-case basis for that.
Let's talk a little bit, if it's okay with you, about the way you make money. So the acquisition of the gold, you charge a fee, it's insured, it's assured to be authentic, you guarantee that it exists. And so is it a bid and ask type thing, or is there a fixed delta or spread?
So we charge anywhere between 0.5% and 1% to purchase the gold, and that's to do the things you just said. It's for the cost on our part to acquire the gold from the refiners and to get it put in the Brinks vault and get it insured and record its existence and show you the digital warehouse receipt and the picture of the bar and all of that. We charge anywhere between 0.5% and 1% a year annualized for storage. Again, storage costs, the gold sits there, it has that insurance, it has costs associated with it. And then we charge up to 0.5% on the sale of the gold. But, and those rates are variable based on the size of the transaction or the size of the position that the client has. And that's our model. I mean, we really want to get people on the network and using the network and gold into the network because once it's there, the more we have on the platform, the more, we're able to offer all these different utility services.
Is it fair to ask you for the utility that you have in place to hypothecate what those interest rates are going for now based on, how interest rates are going? In other words, if you've got $1 million worth of gold and you want to maximize the loan LTV on it, it doesn't matter. Let's just say that, use that as a number. Is it 4%? Is it 5%? Is it 6%? Or is it a function of the creditworthiness of the borrower aside from the asset? How's that work?
I don't want to speak out of turn on this. This isn't my area of expertise. I know the rates are very low because it's a collateralized loan. So
Right.
The credit risk is virtually non-existent. I don't know if that's completely true, but you've got a collateralized loan. The gold is your collateral. So, that makes the loan very, very
Fundable.
competitive.
Yeah. Fundable. Yeah.
In terms of LTV, the institutions we've been talking to will loan anywhere between 80 and 90% against it.
Yeah.
And it makes sense to keep a cushion against that in case the price of gold drops and you don't have to make additional margin calls. But that's a pretty significant loan to value ratio for any type of a collateral that you would use in a loan.
Is the alternative that, for example, the person that asked that they have 500 kilograms, is it typically something it can be loaned against if you actually just own the gold in the vault, or is that does it need to have a utility around it that exists to do that, or is that something commonly done?
It's not commonly done because until we've been able to offer this way of perfecting the collateral. So by being able to transfer the record of ownership digitally and instantaneously, that's a way for a lender to be comfortable that they'll be able to get their hands on that collateral. Now it's different if you've got your gold in a vault in Cayman or Jersey or Dubai or even New York. How does the CME get their hands on that? So the way that we use the Gilded Network, we've solved that problem.
Yeah, I think that's super interesting because the argument against gold has long since been that it has no utility, right?
That's right. It's the why would you buy it? It doesn't do anything, and
rock in a box.
Yeah.
So it has offered positive returns because gold has uses. When the economy is going well, people buy jewelry, they buy iPhones. Gold's in everybody's iPhone. They take spaceships up into billionaires take joyrides into space. Yeah. They use gold in those. So that it's useful in good times, and in challenging times, people flock to it as a flight to quality, as a place of safety. And so it has offered positive returns over time. But now, if you can offer some functionality, if you can offer some use case for it, then people that holding too much cash because they think they might have an investment opportunity, they may have an emergency. They may get divorced. They may have lots of reasons why they need cash on hand or feel that they do. But if you can access liquidity from your gold, on very short notice, then that solves some of those problems from holding too much cash.
In the long-term value charts of how gold is performed over time against other asset classes, and I don't want to complicate things, but this, I know other people are thinking of this, right? So if you assigned a 1% per year friction against holding gold, just to store it, just to use your fee, for example, because there's always friction. There's friction in being an LP in a fund, there's friction in being in cash, there's friction in being in stocks. I mean, it's friction in everything. So did you account for the friction in comparing it against other asset classes as in terms of performance?
So, we looked at the other asset classes without friction too. So my old
Fair enough.
business,
That's all that matters. Yeah, that's
right. So, but my old business was investing in hedge funds, and so
Yeah.
you've got a 2% off the top from the
Yeah.
fund, and then you got another 1% off the top for the fund to funds advisor.
Right,
So you've got layers of fees on fees
Yeah.
there. So if you want to look at the sort of alternative asset portfolio or even the equity portfolio, depending upon how you access it, there are going to be certain frictions there. But that's a great point, Arthur.
Yeah.
Kind of view cash as a friction right now, and it's called negative yield.
Yeah. Especially in other parts of the world. Yeah.
I mean, we were talking about inflation, and yeah, inflation is high. The problem though is that interest rates are not high. So you have low yield, yet high inflation. So we're looking at negative yields right now, like we haven't seen in decades. And so that's your friction on cash. So if you're paying 1% a year to store gold, you're paying what, 6-7% a year right now to hold cash.
Yeah.
You don't pay it, but it's there.
It's a drag. Yeah.
Vetted. Yeah, exactly.
You don't have to convince me to buy gold because I already own it. I might be able to take some of my cash and be compelled based on the argument to move some of it to gold. So there's a lot of people that already have it. So what's the best way to take what you already have and move it over? How big of a deal is that?
You mean to move an existing gold
to
holding
Gilded? Yeah, let's just say that, for example, I've got $1 million of gold in bars. I'm bought it the traditional way. I didn't buy it inside of a bank because of the balance sheet issues. Can I how long is it going to take me to move it over to be on your platform?
So to be honest, we haven't done a lot of that. I mean, really the product is set up for us to acquire the gold directly from the refiners and put it in the vault. Doesn't mean we won't do that or contemplate it or work with a client on that. It's just, it's a little off standard from what we're usually offering. So yeah, I mean, it would be case by case dependent. Where is it? How is it stored? Is it 99.99% pure right now? Does it need to be re-refined?
I got it. Okay.
There's a lot of, the short answer is it depends.
Yeah.
The shorter answer is it's a lot easier just to buy it through Gilded.
So let's talk about that. So somebody says, okay, I got $1 million. I want to put it into the asset class. What's the process from beginning to, okay, done?
So you'd open up an account with Gilded, you'd fund it. First we would do
KYC, AML, all that stuff.
Yeah, that's we're going to do that as we would any other financial institution would. We would then have you fund the account via wire or ACH or whatnot. Once that money is in the account, you could place an order for gold at the fixing rate. You would designate which rate you would want or which time you would want, and we would acquire the gold and we would have it shipped to the Brinks vault of your choice if it's not already there. We do have inventory of gold in certain vaults, so it might already be there, but if it's not, it would be shipped to that vault and that would be your gold. And then once it's your gold, it's there, and we would work with you on the other aspects that we discussed today in terms of lending and other things. Yeah.
I'm just wondering if there's a carry trade on this, but that's for another, right? Because you provided a utility for gold. I mean,
this is one of the things that we think is really interesting, is to earn a yield on your gold, right?
Yeah.
So there are ways that you can do that. You can use your gold to to acquire second loss reinsurance premiums. So you
Yeah.
can have a yield there that's a relatively low risk yield that all of a sudden adds to your returns on gold. You can do it for social causes. So we're investigating working with groups that do microloans to small inner city businesses to start their businesses. Whether it's a food truck or a barbershop or a small enterprise. Those tend to be pretty good loans in a statistical sense. And so sometimes investors want to have a social good component. They also get to earn a yield on that. We can also use option structures in a traditional way to use sort of put call structures to put collars around your gold position. So we may give up some upside yield, but you may limit downside. And in the meantime, you earn a coupon effectively by holding your gold. So those things are really powerful to be able to, for the right investor, to satisfy particular needs and to be able to hold an asset that's protecting them against inflation at the same time.
Yeah, there's made me think of one of the hazards of holding gold and buying it through your, I know you guys have UBS history, but you buy gold from UBS and they store it, you're on their balance sheet. And no matter what you say to the contrary or try to edit the contract, they can hypothecate things overnight that are yours, right? In this case, the only person they hypothecated is you.
So that's right. So that really comes down to the heart of the matter here, which is Gilded is offering access to physical property that is your client's title. It's their property. So when you hold gold at JP Morgan or UBS in their unallocated vault, it's a pool of gold bars. They'll pull one out when a client says, I'd like my gold bar back. They'll pull one out. But if a bunch of clients all ask at the same time and these bars all come out, will there be enough of a pile of gold there to satisfy all the demand? Those are big questions. It changes the nature of the investment. And in most cases and most periods of time, no problems with those issues, no problems with an ETF. But if we're talking about intergenerational wealth and we want people that are insulating and getting a hedge against systemic risk, then you want to make sure it's your property.
Yeah, totally makes sense. Well, we've run up against time here, guys. Somebody want to wrap it up with a closing statement?
Sure. I mean, I think we've covered it. You've got a problem in the world of a lot of cash. It's devaluing. There's inflation. Your alternatives right now are all come with some kind of an issue, either from a liquidity standpoint or in the case of crypto, very volatile asset class. But by combining the digital aspects of blockchain with the physical aspects of traditional gold, we think we've solved that problem and created a opportunity for investors to use gold in a new way, not just as a store of value, but potentially as a medium of exchange and as a cash alternative. Ray, I don't know if there's anything you want to add to that.
No, I just want to thank everybody for their time today. And Arthur, thank you. It was a pleasure working with you on this today.
My pleasure.
Yeah, thank you very much.
Super great having you guys twice and listening to the story, and we'll make sure everybody gets in touch. And as I always say,
we're happy to do one-on-one meetings if anyone would like to discuss this in more detail or get more specifics about their own situations and sort of how we might work with you together on that. We're happy to do those.
Or see a demo of the investment product and the tool, how you'd access it. We're happy to do that.
Yeah, and as I reminded everybody, if there's anybody that you know of that would benefit from hearing about this, you're welcome to include them as well. So as I always say, thank you all for sharing with us the only thing you can't make more of, and that's your time. Till next time, thank you.
Thanks, everybody.